Which company valuation model should I trust? Imagine trying to figure out what a company is really worth, like guessing the value of a house but with more numbers and less paint. When it comes to stock trading and options, knowing how to value a company can make a big difference. But with so many models out there, which one should you rely on? Let's break down the main types and see how they fit into your trading game. First, valuation models fall into two main groups: absolute and relative. Absolute models aim to find the true worth of a company based on its own financials. Relative models compare one company to others in the same industry or market. Both have their uses, but understanding their differences helps you pick the right tool for the job. Absolute valuation models include the dividend discount model and the discounted cash flow method. The dividend discount model looks at the dividends a company pays out and discounts those future payments back to today's value. It works best for mature companies that pay steady dividends. If a company doesn't pay dividends or has irregular payouts, this model isn't very helpful. The discounted cash flow model estimates a company's value by projecting its future cash flows and then discounting them to present value. This method is flexible because it doesn't require dividends. Instead, it looks at how much cash a company generates and reinvests. But it relies heavily on assumptions about future growth rates and discount rates. Small changes in these assumptions can lead to big differences in valuation, so it needs careful handling. On the other hand, relative valuation models compare a company to similar businesses using ratios like price to earnings, price to book, or enterprise value to earnings before interest, taxes, depreciation, and amortization. These are quick and easy to use, especially for traders who need to make fast decisions. They reflected current market sentiment because they're based on real-time data. The challenge is finding truly comparable companies, as differences in growth or risk can skew results. For traders, speed is often more important than perfection. Relative valuation methods are popular because they give you a quick snapshot of whether a stock looks overvalued or undervalued compared to its peers. Absolute models like discounted cash flow or dividend discount model are better suited for long-term investing or when you want a detailed picture of a company's fundamentals. They can reveal discrepancies between a stock's market price and its estimated true value, which might signal a trading opportunity. But remember, no model is perfect, all relying on estimates and assumptions. Market conditions, investor sentiment, and unexpected news can cause prices to move away from what models suggest. That's why many experienced traders use both types: quick comparisons with relative models and deeper analysis with absolute models. So, which model should you trust? It depends on your trading style and goals. For quick trades and options strategies, relative valuation is often the best choice. For longer-term plays or when analyzing companies with unique characteristics, absolute models like discounted cash flow can give you a more detailed view. Many traders combine both, using relative models to spot opportunities and absolute models to confirm their ideas. The best approach is to cross-check your valuations with multiple methods. If different models point to similar conclusions, you can feel more confident in your decision. Always keep in mind that models are guides, not guarantees. Market prices can stay away from what models suggest for a long time, and that's part of trading. In the end, understanding the strengths and limits of each model helps you make smarter choices. Using a mix of quick comparisons and detailed analysis gives you a balanced view. That way, you're better prepared to navigate the ups and downs of stock trading and options.